political issue in Russia and Ukraine just provide an excuse for some of the European investors and Russian investors to park their money in Hong Kong. And people is looking at a better economic outlook of China. And that's provide an ideal timing for them to change the investment mode, and now the market has returned to a risk-on environment.
Because the money is going into the stock market, so presumably the money that's coming from these Russian companies are going to end up in the stock market.
I would think so. You know, when you look at the capital in and the reason for the capital inflows, you can either believe either the money want to invest in the Hong Kong property market or the Hong Kong stock market. But right now, it doesn't seem to me that Hong Kong property is so attractive.
Especially at a time when the Shanghai-Hong Kong Connect is coming through by October.
Exactly.
Is that a big factor?
I believe so. Now, lots of global investors see this forthcoming Shanghai-Hong Kong Stock Connect could be another major gateway for them to expose to the onshore stock market, because through this Hong Kong Stock Exchange, you can indirectly invest in the Shanghai Stock Exchange, and you can expose yourself to the more prosperous and with Chinese companies with an improved prospect.
Looks like the Hong Kong Monetary Authority's got a huge job of defending the currency.
I believe so.
It will have to buy more U.S. dollars as this comes through, because there will be stronger capital flows.
Exactly. Usually in the second half of the year, you can expect a rally of the Hong Kong stock market, and the performance of the Hong Kong shares usually perform better. You know, now the PE ratio in Shanghai is only down to 10.6%, 10.7%, and that's a very, very good low PE ratio. And people started to think about the Chinese stock is becoming more attractive.
But it's not going to look pretty when it comes to the property market, because we're talking asset price inflation. If we get stronger capital flows, then that's going to push up property prices.
I think from the macro perspective, of course, a strong capital flows always provide a pressure for the Hong Kong government to address the problem of asset price inflation. We are talking about a balance between the investment demand in the real estate. At the same time, Hong Kong needs to address the housing needs of the local residents. The fact is that Hong Kong does not have its own independent monetary policy because of the linked exchange rate system. So it comes to a question of how the Hong Kong government can address the issue through fiscal policy or macro-prudential measure in order to curb the speculative demand in the local real estate market.
But are those measures enough, or will the Monetary Authority have to depeg to prevent asset price inflation?
I don't think Hong Kong will unpack, and the linked exchange rate system works fine in the past, 31 years almost. The question is how the government can compensate those who are being affected by maintaining the linked exchange system, but at the same time they want to address the housing needs and some other sector that are being affected by the high inflations. So the only way for Hong Kong to do is to use its reserve, and huge amount of fiscal reserve that is sufficient and enough to compensate those who are being affected by maintaining the linked exchange rate system.